The Fed chairman has given the market a very important clue on this date, 13 December last year. And at what level will the Fed consider an interest rate cut? And this is what Jerome Powell said. He said that I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2%. He's very specific about it in a sustained way. Now, what happened here is that we could see that last year, October, somewhere around here, the market started to rebound. And on this date, when he mentioned that down to 2%, that day itself, the market ended with great disappointment. And from there, the market continued to move down. And especially for NASDAQ, it moved down even more. And what we're looking here is S&P here. Now, so what happened here is that let's understand about the inflation numbers called the CPI. And we could see that the inflation started picking up in February 2021. And that's where it settled at about 7.1. And essentially what the market consensus here is that for 2023, many of the market watcher, including myself, do not believe that the inflation is going to come down to 2%, maybe about range bound. This is what my projection is, maybe between about 5 to about 9%. Nobody knows, but this is what we're seeing here. Now, so if this is true, so what happened here is that now when we look at here is the interest rate hike over last year, 2022, and it started at 0.25%, ended at 4.5%. So what the Fed trying to do here is that they're going to hike the rate moderately at about 25 basis point. We're not seeing a massive rate hike. If the CPI maintain at about maybe about 5 to about 9%. So at the end of all the 8 meetings that we are having in 2023, if each meeting is at 25 basis point hike, what we're seeing here is that at the end of the year, we are seeing a 6.5% on the Fed fund rate or the interest rate. And this is, in my opinion, it could be the best case scenario. Now, so today's topic, we have to acknowledge that 2023, the inflation will stay. And so how are we going to deal with it? My strategy for commodity is to buy them, and for the stock market is to trade them. And this was my strategy last year in 2022, but I will continue to flow them over to 2023 as well. So I'm going to share with you what I've done last year, and I hope that you will find it enjoyable. But before that, please take some time to read into the disclaimer down here. Now, let's get started for the first part about commodity. Now, what do I mean by to buy them? Now, let's look at the last year example here. And I have this video posting on the 25th October here. Now, when I say commodity buy them, does not mean that I'll just buy straight away. What I'm referring here is that to buy on retracement, because in the inflationary pressure, so basically what we're seeing here is that generally the market is on an uptrend. So each retracement is an opportunity to look out for a buying signal. So this was a video post that I posted on the 25th October. And the title is Gold Still an Inflationary Hedge Assets? Of course, my answer is yes. So at a point in time on this date itself, I felt that it's about time to enter the market. And you could visit a video, and I will share the link below, where I discuss about how to construct a primary uptrend line and a secondary uptrend line. For commodity to buy them, the strategy is buy on retracement. And this is a point of retracement. And it kind of stopped here on 25th of October. And let me just share with you the latest. And this was 25th of October. And this is where the market is right now. Essentially, it's about 200 points or $200 higher in the gold prices. That's what we're seeing here. Now, let's move over to the next topic here on the stock market, to trade them. Now, when I say to trade them, what do I mean by that? I'm selling and I'm buying, and I'm selling, I'm buying. In a downtrend, my strategy for the US stock market or US stock indices is to trade them, means that I'm doing both sides. Now, but before that, let me just share with you what I've done. So on this day itself, on this forum that I have on timing the market, we discussed was that we saw there was 2021, there was a bearish engulfing body, And on question 3, I asked the members that how should we plan our entry? So take profit on the stock that we have long term and turn short into the US indices on the derivative. So that's what we have discussed. Now, so where was the bearish engulfing body back then on the 26th November 2021? It was here. And subsequently, it kind of broke the uptrend line. And this is a deciding factor. As it broke this uptrend line, I've turned a long-term view on the buy side to a sell side on the third week of 2022. That was last year. So again, when I say US stock market to trade them or the US indices to trade them means that I would prefer to sell into strength. Because when I sell into strength in the bear market, I could hold it a little bit longer, and I do not mind to buy, but I will keep my buy position short term. This is to trade the US market, as you could see, that is jagged. So this was my expectation at that point. It was on the 21st of October. I expecting the market to move up and also expecting the market to come down. So let's look at the result again. From there, and 21st October, the market did move up and then now it's on the way down. So this is what I mean, that in an inflationary pressure, it is not a good news for the stock market. So I'll prefer to trade the US indices. Now, the next question here is this: how can we hedge into this inflationary pressure, or can an interest rate be traded? Now, the answer is yes. And what we're looking here is the 30 years government bonds yield. And we could trade them. How to understand that is that this is CME micro 30 years yield futures. And it states that the minimum fluctuation is 0.001 point, as you could see. It has moved up. And we have to first understand about each minimum movement, how much it's worth. It states that it's $1. How about 0.01 point? It means that it's $10. 0.1 is 100 US dollars. And 1 full point is 1,000 US dollars. And we could see that there was a 1 full point movement. So this is a potential profit or losses if you're on the opposite side. But for the interest rate, what I'm going to do here for the whole 2023 is the same. And I believe that interest rate or yield that's on the rise, our very similar to the gold strategy or commodity strategy, my focus were to buy on dips for the interest rate. And this is how we can hedge or to trade into the interest rate market. So for more market in-depth understanding trading into the US stock market, I have also created a playlist called Trading Series. Do follow me on my next quarterly live webinar. We will study and discuss into the current markets. You can find the sign up link below. Also, if you enjoy researching the markets and its opportunities with some help from a platform like mine, I have included the discount link as well. Thank you for staying true, and you have many great trading weeks